Welcome back to Market on Close. We have just a few minutes left in the trading day, so let's bring in our team from Charles Schwab to get the big picture on the week. A very busy week for us to recap here. I'd like to bring in Joe Mazzola, the head trading derivative strategist for Charles Schwab. Joe, thanks as always for being with us. Lots to talk about on our day of a pretty aggressive downward move. So let's kick it off with the jobs report. Really surprising jobs number.
Yeah, way below expectations, and I think the real kicker was the fact that we had the revisions and basically put us below that 100K mark for really 3 months in a row. I think that's something that needs to be talked about is the fact that you can't really talk about too much job growth, and then maybe flies in the face of what we heard from Chairman Powell on Wednesday when you see those real steep revisions. So, maybe it was poor timing for him, or unfortunate timing, I guess, but. Either way, the market's response to that data became, really grim very quickly. And you look at that on top of the fact that we heard a little bit more of expansion in terms of the tariff announcements, and it just set up for a really weak morning. And maybe contrary to what we've seen in the last few weeks, there was not really much buying throughout the course of the day. There were a couple of times where you saw the market trying to turn around. But as where we're at right now, we're fairly close to the lows, not at the lows, but fairly close at this point.
And, when you saw these numbers come in, Joe, how important was it? We view that 100,000 pace as being a sort of like psychologically important number. So once we saw all 3 months revise under, do you think that that's where the most significant ding was? Is it that it was that big round number and we missed?
I think there's a couple things. So number one, if you look at that 3-month moving average, that takes us back down to around 2020 in terms of the worst 3 months, in recent history. So that's in the middle of COVID. So that's not something that we, want to look at as a positive reflection on the job market. But I think that in coordination with what we saw earlier in the week. So even though GDP number was strong at 3%, remember there's a couple things below the surface that I thought were interesting. Number one was that, the personal consumption number didn't even increase by 1% from consumers. It was really, exports and capex from large companies that kind of drove up that number towards 3%. And then when you looked at the PCE data, once again, we saw personal spending a little bit lower than expected. So what does that signal? I think that's what market's trying to wrap its head around right now is, do we have a slowing consumer? And I think what we're seeing so far from the earnings data is that, the last few months we've seen that to a certain extent. Earnings have come in very well. So, let's take a step back and say that first and foremost, but, the bar was set a little bit low. And so what I think is important that'll be coming out over the next couple of weeks, especially now that we move past kind of the majority of the Magnificent Seven. We still got one to go. But as we look towards industrials, as we look towards discretionaries and staples, what are we seeing from the consumer? Are they pulling back in terms of what they're willing to pay? Are they trading down? We'll know a little bit more early next week with the durable goods number. But I think that is what maybe the market is queuing in on right now and saying, okay, is this something that we need to be concerned of over the next couple of months when that tariff effect really starts to take place?
Yeah, I mean, and certainly we're starting to get some of these tariff numbers and seeing reactions to those. They don't take effect until next Thursday. So there is some time for a few more agreements to be made. But were there any of the tariff rates that stuck out to you for any specific countries?
Yeah, if you're Canadian, absolutely. Yeah, taking it up to 35%. I'm sure Mark Carney wasn't too thrilled when he saw that. But I think that's a big one. I think the market felt a bit of relief when that 15% deal was done with Japan, and then we saw something similar with the EU, and maybe just was kind of pricing in. Okay, well, 15% is probably going to be the way to go, and then now we're seeing some outliers here. But as you mentioned, Molly, there is some time to kind of work those out or extensions if need be. China has till August 12th, so we'll see where that goes. But it's sometimes you get a catalyst, right? And I think today was that catalyst where things, had been priced for perfection. We hadn't really seen much hedging activity in the options world. If anything, there was, some complacency there, but boy, did that turn around today. Just a couple examples. So, a few of the things that I look at, from a trader perspective, when I'm looking at things like skew on the S&P 500 or the SPX, I look at, puts versus calls, 10% out of the money. And we were at about the 45th, 46th percentile, meaning, basically average, right? Heading into today, now we're up at the 75th percentile, which you're seeing a lot of people buying some downside protection. I guess the question is always, is it too late? I don't know. I mean, we just dropped below the 20-day moving average for the first time in the S&P 500 basically since May. And so we've had this parabolic move to the upside, which is, people have bought every time that we've kind of pulled back. It's not a severe pullback right now, but what we started to see was less and less of maybe that upside buying as we've, been kind of making it through new highs these last couple of weeks. So when you do get a move like this, it creates a little bit of a air gap. Now, I guess the key will be whether or not that continues next week.
And it certainly wasn't the market mover like the jobs report was in some of the tariff news, but we also saw some weaker ISM data come in today.
Absolutely. Yeah, no, I think that's important. I think it's actually really important because what it shows is two things. Number one, manufacturing continues to slow down. It's in contraction. That move down to 48, that's, that once again, a really, really big move down, the worst level we've seen in over a year. And on top of that, a couple major components, new orders came in lower than expected, and employment came in lower than expected. So what does that mean? That means that you're seeing some pretty substantial contraction in the manufacturing world at the same time that we're seeing prices paid and we're seeing input prices go up for manufacturers. So I think that points a picture of an economy, at least in the manufacturing side, that is really slowing down fairly quickly. They're not hiring. There's not a lot of new order activity out there. And, what's going to be important next week is when we get the services number, because that's still a bigger component of our economy than manufacturing. But if we start to see some weakness there, then you might continue to see yields come down and overall stock market come down as well, too.
Yeah, some cracks starting to show. Joe, we appreciate you breaking down all of that data with us today. That's Joe Mazzola.